So, Mullen Automotive has done it again. Another reverse stock split. Another press release promising future tech. Another glimmer of hope, just bright enough to distract from the wreckage behind it. And at this point, let's be honest, it's not even a joke anymore. It's a slow-motion collapse playing out in broad daylight. Let's break down exactly what happened, and why, for many investors, this might finally be the last straw. Let's start with the headlines. On April 9th, Mullen put out two major announcements. The first was a supposed win, a partnership and supply agreement with a company called Enpower Greentech Incorporated. The second? A devastating blow to shareholders, a 1-for-100 reverse stock split. Let's talk about that reverse split first, because it says everything about where this company is right now. On April 11th, Mullen Automotive will consolidate every 100 shares into one. That's not a typo. If you hold 10,000 shares right now, you'll have just 100 after the split. And before anyone starts clinging to but the value stays the same talking point, let's not kid ourselves. Reverse splits at this scale are almost always a death spiral for retail investors. They don't fix anything. They just buy time. Temporary compliance with the Nasdaq's $1 minimum bid price. That's it. And you don't need to take my word for it. Just look at Mullen's track record. This is now the fourth reverse split in less than 2 years. First it was 1-for-25. Then 1-for-9. Then 1-for-100. And now, again, 1-for-100. Each time, it was pitched as a necessary move to keep the company alive. Each time, shares cratered even further. And each time, the same retail investors were left holding the bag. But wait, there's more. Let's talk about the partnership with Enpower Greentech. According to Mullen's press release, they've entered into a deal to manufacture Enpower's Swift series of semi-solid-state batteries at their facility in Fullerton, California. Production is supposed to begin in early 2026, almost 2 years from now. And while the deal sounds futuristic, semi-solid-state batteries, manufacturing innovation, domestic production, it's all forward-looking. There are no confirmed orders. No revenue guarantees. No timeline for when these batteries might appear in Mullen's vehicles, or even if they'll ever reach commercial viability. Let's face it, this feels like another shiny object. Another press release. Another distraction. It's part of a now familiar pattern. Whenever the stock plunges or a reverse split is on the horizon, Mullen conveniently announces a new partnership, or contract, or breakthrough. But when you follow up a few months later, nothing materializes. The trucks haven't shipped. The deals haven't closed. And the money's still bleeding out the door. Let's take a step back and look at the actual numbers. As of today, Mullen stock is trading at 4 cents. 4 cents. That's a 20% drop on the day, and it's not because of broader market volatility. It's not because of macroeconomic pressure. It's because the company is diluting shareholders into oblivion. Just last week, they filed to sell up to 200 million new shares. That's right. 200 million. On top of the nearly 2 billion shares they've already issued since 2022. And let's not forget the absurdity of it all. This company was once seen as a high-potential EV disruptor. There was genuine excitement. A US-based manufacturer. Bold leadership. Ambitions to rival Rivian and Tesla. But today, it's a penny stock zombie, desperately trying to stay alive through financial engineering and press release optimism. The trucks? Still mostly parked. Revenue? Barely a blip. Expenses? Off the charts. And investor confidence? All but gone. And now the big picture, the macro environment. You might think that with the US ramping up protectionist tariffs, including Donald Trump's 25% Liberation Day tariffs on foreign vehicles, that this would be a tailwind for a domestic EV company like Mullen. And you'd be right, in theory. But here's the problem, Mullen doesn't have the scale. It doesn't have the production capacity. It doesn't have the trust. Tariffs might hurt imports, but that doesn't automatically mean Mullen is going to fill the gap. Bigger players like Ford, GM, and even Tesla will eat up that market share. Mullen's not positioned to benefit. It's just too small, too under-resourced, and too financially unstable. In fact, the tariffs might actually hurt Mullen, because many of its components and tech partners are international. That includes supply chains for batteries, chips, and other key systems. The irony? A tariff meant to protect American manufacturers might end up making Mullen's parts more expensive, without any corresponding sales boost. So here we are. Mullen is about to do another 1-for-100 reverse split. It's issuing another few hundred million shares. It's trying to pump up confidence with a flashy battery partnership that won't generate $1 until 2026, if ever. And the stock is 4 cents. This isn't just a struggling company anymore. It's a cautionary tale. A textbook example of what happens when dilution becomes the business model. A reminder that hope isn't a strategy, and that not every EV company is the next Tesla. And for those who are still holding, still hoping for a miracle bounce, I get it. I've been there. But this? This isn't even a joke anymore. It's sad. And it's brutal. And it's why due diligence matters more than ever. If Mullen turns it around, great. I'll be the first to say congratulations. But based on what we've seen, the repeated splits, the dilution, the lawsuits, the unfulfilled promises, this feels like the end of the line. This isn't financial advice. But it is a reality check. Reverse splits don't build value. Partnerships don't pay the bills unless they generate revenue. And flashy press releases can't hide a crumbling capital structure forever. Mullen had its moment. But that moment is long gone.